Hey, welcome back to my finance coaching channel. My name is David Tan and I'm a qualified chartered accountant. I'll be coaching you in simple layman terms so that the subjects of accounting and finance will become really simple and will no longer be terrifying to you. Over time, you will not only be proficient in reading and analyzing financial statements, but will also find it profitable as they are an essential tool for driving business success and for assessing stocks in the stock market. In this episode, we'll be focusing on the balance sheet, and I will coach you using a real-life example taken from Wall Street. We will be using the balance sheet of Google. Let's dive right in. For those who are new to this channel, I'm doing a series known as Finance Made Simple. I will start from the fundamentals by taking my viewers through the 3 basic financial statements. In today's episode, the focus is on the balance sheet. Before we go into an actual balance sheet, let's look at the definition of what a balance sheet is. Investopedia defines the balance sheet as follows. A balance sheet is a financial statement that reports a company's assets, liabilities, and shareholders' equities at a specific point in time, and provide a basis for computing rates of return and evaluating its capital structure. It is a financial statement that provides a snapshot of what a company owns and owes, as well as the amount invested by shareholders. For those who are new to the world of accounting and finance, you may already be confused and wanting to run away from this channel. But wait! For those who have watched my previous video, you will recall this slide. Now I want you to rewind and read the definition again, noting the underlined words and how it relates to this diagram. You would already be familiar with the terms assets, liabilities, and shareholders' equity. What a company owns are its assets, and what it owes are its liabilities. The amount invested by the shareholders is accounted for in the balance sheet as shareholders' equity, which is the special form of liability that the business owes to its shareholders. That is why it's on the liability side of the balance sheet. Can you see now how simple it has become? Let's move on now and see how we can apply this knowledge to a real-world example. This is Google's balance sheet, taken from the Wall Street Journal. You will find the link in the description below. When you do a drop down at the Financials tab, you will immediately notice the 3 basic financial statements. As you scroll down the balance sheet, you will see the Assets section as well as the Liabilities and Stockholders' Equity section. Whenever you are overwhelmed by the amount of information, always remember to go back to this diagram where I've simplified the balance sheet for you. As an accountant, one of my favorite tools is Microsoft Excel. I've ported Google's balance sheet numbers into an Excel sheet and simplified it into assets, liabilities, and stockholders' equity, and all the numbers now add up perfectly. We shall now go into each section of Google's balance sheet at the Wall Street Journal site. For current assets, I've highlighted 4 items which you need to be familiar with. The current assets breakdown appears in most balance sheets of businesses across all industries. For example, all businesses need cash. It has amounts owing to them by debtors, also known as receivables, and many businesses hold inventories. You will often find the word others in financial statements. In this example, where some types of current assets could not be classified under the large categories of cash, receivables, or inventory, there is a category called other current assets. Moving on to non-current assets, the 4 main categories to take note of are property, plant and equipment, also known as PPE, investments, intangible assets, and again you see other assets. In this case, it refers to other non-current assets. Though I've highlighted 4 categories here, the most common one in businesses are the property, plant and equipment, especially when the business is not as large as those in listed companies. As a business grows, it will have a surplus of cash, and that is where the cash gets invested into long-term investments. As a business becomes more established, its brand name will also become more valuable, and that's where the intangible assets of goodwill gets accounted for in the balance sheet as a non-current asset. For current liabilities, though I've highlighted 4 subcategories, the most common one in businesses is the accounts payable, which is the amount owing by the company to its suppliers. Similarly, for non-current liabilities, there's only one subcategory that is common across businesses, and that is the long-term debt, which is usually money borrowed from banks to finance the business's operations. In the shareholders' equity section, you will need to know 2 main items. The first one is paid-in capital, which represents the capital that is injected into the business by the owners of the business in exchange for stock. The second item is the retained earnings, which represents the accumulated amount of profits or earnings that is retained in the business after paying out dividends to its shareholders. As this relates to profits, it will lead us nicely into the topic of the next episode, the income statement, where profits are derived from and flows into this retained earnings section of the balance sheet. As complex as all this may sound to anyone who is new to accounting, always remember that it can be simplified back into this diagram. If you like what you have learned in this episode, please smash the like button. Please also share this video with anyone you know who may benefit from it, such as a student, a friend, or a colleague who is struggling to understand financial statements. In the next episode, we'll explore the income statement of Google. Please ensure that you are subscribed to this channel and activate the bell icon to be notified of it as soon as I post the next video. Till then, take care and stay safe.